Okay, as part of our study and revision of economic cycles, we're going to spend a few minutes thinking about and analysing and evaluating economic booms. So a boom is an often short-lived, sometimes fairly transitory period of rapid growth of GDP, which nearly always leads to falling unemployment, a rise in inflation, and also an increase in the price of assets. Now, a boom technically occurs when real GDP, that's inflation-adjusted national output, is growing much faster than the estimated trend rate of growth. And this can lead sometimes to an economy going through a kind of an unsustainable period of growth. We call this macroeconomic overheating. Booms typically result in a positive output gap and an increase in both demand pull and cost push inflationary pressure. Here's the data for the UK. I just thought I'd show the figures for the last 20 years or so. The figure for 2022 has an asterisk there. That's because it's a forecast. I'm recording this in April of 2022. But you can see that the UK economy grows most years, but not very quickly. In fact, the trend rate of growth for the UK is around 2%, maybe a little bit above 2% per year. So we're not the sort of country that grows at 4 or 5% each year. Our trend growth is about 2%. So picking out economic booms is quite hard. I mean, 3% is above the trend, 2014, for example, but you wouldn't call that necessarily a boom. The actual growth, of course, does vary from year to year as it passes through different stages of an economic cycle. So 2021, 7.5% growth of GDP. That sounds plausible to call that a boom, but of course, look what had happened the year before. GDP fell in real terms by nearly 10%. If we track the index of GDP, we can see exactly what was happening here. We'd had this long period of fairly steady growth, not really a boom, but a strong, sustained recovery. Then the pandemic hit, big fall in output, 2 lockdowns. Output has now recovered, but only more or less to where it was back in 2019. Now, a key point for the exams is that economic booms typically, not always, but typically are fairly short-lived. Some countries can have a boom lasting 5, 6, 7, 8 years. A good example might be, for example, Australia or China. But most countries, the booms are fairly short-lived because of the other macroeconomic consequences, the effects they cause, not least the rise in costs and prices. And typically, central banks, when they're in a boom, start responding by tightening monetary policy, by raising interest rates to try to limit or curb inflationary pressure. Let's work through some of the analysis. In this video, I really want to take you through some of the diagrams you would use if you get a question on an economic boom. And we'll work through 2 sets of diagrams. One is the Keynesian aggregate demand and supply model, and then we'll look at the neoclassical model. So we'll work through both to help you with your revision. So a boom could be caused by a significant increase in aggregate demand. Here AD1 shifts to AD2, and that leads to an expansion of production national output from Y1 to Y2. The outward shift in aggregate demand causes an expansion along the aggregate supply curve. It can also cause a little bit of an increase in prices, although here we are talking about the elastic section of the aggregate supply curve. So hopefully you can see here that the increase in real GDP is significantly bigger than the rise in inflation. But if aggregate demand continues to grow at a quick, rapid pace, this is when you move into the boom territory. Output goes up to Y3, but now the economy in a boom phase is coming close to full capacity or full employment national income. As a result, you get significant inflationary pressures. So the general price level might go up. Oh, that should be to GPL3. I'll just change that. Good spot. GPL2 up to GPL3. And the increase in aggregate demand, when the economy is coming close to full capacity, leads to an increase in the general price level, GPL3, but only a relatively small increase in real GDP. So this is a good diagram to draw if you get a question on a boom, but in particular, the movement of the aggregate demand curve from AD2 to AD3. Now, we could also use the neoclassical model, and in fact, in many ways, this is probably the better diagram to use if you get a question on the boom phase of the cycle, because it does allow you to talk about the output gap concept a little bit more precisely. So let's put in the aggregate the supply curve. The long-run supply curve gives us our potential national output. So at Y1, the economy is below potential, but then aggregate demand increases from AD1 to AD2. Maybe a boom in exports, might be a boom in consumption caused by higher asset prices, so on and so forth. Real GDP goes up from Y1 to Y2, but it also leads to an increase in the price level. So we've got this classic combination of rising demand causing both economic growth, but also a rise in inflation. Now again, if aggregate demand continues to grow, if aggregate demand continues to increase from AD2 to AD3, now can you see that the economy is operating at a level of output above potential? So in this sense, the output gap, the difference between Y3 and YP, becomes positive. And of course, that can also cause a further increase in inflation. Businesses working flat out may choose this moment to increase their prices because they know they can make more profit. Now, typically in a boom phase of the cycle, demand is growing, prices start going up, and it also leads to higher costs. So wages might start going up as the labour market tightens. Commodity prices might start rising as the derived demand for factor inputs goes up. So your coal, your gas, your fertiliser, etc. becomes more expensive. As a result, aggregate supply will shift in the short run to SRS2. That takes the economy back towards potential output, but also leads to a further increase in inflation. So this would be the diagram I would draw if I was trying to analyse some of the effects of an economic boom. I would be using this diagram. But just check with your exam board to see which approach to ADAS they would like you to use. And this is a great diagram. If you want to put it into your revision notes on a boom, just take a screenshot and you'll be in great shape. Sometimes you're asked to talk about the consequences of a boom. At a micro level, obviously there's a potential for increased supernormal profits for businesses as demand is growing. In the labour market, there should be an increased demand for workers because labour has derived demand. But in terms of points 1 and 2, not all businesses, not all industries will necessarily see a fast, rapid growth of demand during a boom. It does depend on the income elasticity of demand for different goods and services. So those products with a high and positive income elasticity will see demand and profits going up. But of course, we also have inferior goods where the income elasticity of demand is negative. And in a boom, sales of those products might actually decline. Households should see more income coming through, perhaps helping to reduce the extent of absolute poverty. So in the developing country context, fast growth can lift per capita incomes and increase incomes above the sort of $1.90 or $3.20 per day PPP. Although absolute poverty may go down, relative poverty, of course, may widen. Oftentimes, growth does lead to an increase in income and wealth inequality. And growth can also lead to a surge in asset prices, including house prices, clearly, but also it causes more expensive properties to rent. You see, as house prices go up, that becomes less affordable for many people, tough to get a mortgage. People then look to rent instead, but of course as demand for rented property goes up, so the average monthly rent might increase as well. And also note at the micro level some of the market failure aspects. So there are some possible environmental consequences to consider, not least increased waste and carbon emissions and other pollutants from higher production and consumption. At a macro level, an economic boom normally, not always, but normally leads to falling unemployment. It depends what's causing the boom, but if demand's growing, businesses will be taking on more people and employment rates will be going up as cyclical unemployment falls. A boom in the economy, particularly a boom in consumer demand, can also drive increased investment. So please revise the accelerator effect. When the rate of growth of demand goes up, a lot of businesses may bring forward some investment projects to give them more supply capacity. And governments typically benefit from booms at a macro level because people are earning more and spending more and companies are making more profit, and therefore direct and indirect tax revenues go up, helping perhaps to reduce the fiscal deficit and control the national debt. On the other hand, if there's a boom in consumer spending, we will tend to be sucking in more imports. And as import demand goes up, that could cause a possible increase in a country's trade deficit. And as we've mentioned a couple of times already, during a boom, the risks of an increase in both cost push and demand pull inflation go up because the output gaps become positive and the economy is reaching supply constraints. Now, I've mentioned a couple of times that economic booms typically, not always, but typically are fairly short-lived. That's the nature of a boom. In many ways, it's unsustainable. And I think understanding some of the factors, both automatic and discretionary, domestic and external, that cause a boom to end is important in understanding some of the dynamics of a business cycle. So the last slide really asks this question: how do economic booms come to an end? Well, many factors. I mean, booms don't last forever. Oftentimes it's inflation that is the trigger for a turning point in the cycle. So as inflation goes up, perhaps above target, often monetary policy is tightened by central banks. They raise their interest rates or they bring down the quantitative easing. And that curbs spending and leads to a rise in saving. And if prices start rising very quickly, perhaps faster than incomes, if nominal wages don't keep pace with prices, then the real spending power of consumers begins to fall, and that hits economic growth. When businesses are facing rising costs, a bit more uncertainty, business confidence may dip and planned investment may decline. And some of the external factors that have caused the boom may reverse. So you might have an export boom because of a strong growth in other countries, but that comes to an end, and therefore that causes a contraction in export sales, production and investment. Two of the really key points are that booms are often associated with asset price inflation, and you may well get a bubble in the price of stocks and shares and housing and other financial assets. Well, if that bubble bursts, the prices of these assets start falling. That can lead to an increased wealth effect, and it's particularly problematic if associated with the asset price boom, there's been a surge in debt. People essentially borrowing money to finance the purchase of financial assets. Indeed, once an economic boom finishes, as we reach the turning point in the economic cycle, banks, commercial banks, may become more reluctant to lend, both to households and businesses. The credit cycle turns. Credit becomes harder to access and more expensive. So one of the biggest factors causing the turning point in an economic cycle, how a boom, for example, becomes a slowdown and perhaps a recession, is a change in business and consumer sentiment. And Keynes, of course, great macroeconomist, understood the psychology of the economic cycle, and he labelled this a change in animal spirits. When our expectations change, so too does our planned spending, which directly impacts one or more components of aggregate demand. Well, there we go. That was some revision on an economic boom, a key stage in the economic cycle. Take care. See you soon.